Welcome, everyone. Happy Tuesday. Thank you so much for taking the time to join today's webinar. Today, we're going to be talking about the 10 benefits of multifamily investing in your retirement account. It is top of the hour, so I do want to go ahead and get started. I'm Reneika Lightbourne with Advanta IRA, and I'm delighted to be joined by multifamily expert Joseph Kimbrough of Apex Real Estate Investments. So thank you so much, Joseph, for being our speaker today.
Thank you. I'm happy to be on.
Absolutely. So today, Joseph is going to cover some of the advantages of multifamily investments, such as economies of scale, group purchasing, and of course, being able to maximize passive income. But before I turn it over, I do want to kind of give you a general overview of what self-directing your retirement account is, how it works, and of course, the process to get started with us. If you do have questions, feel free to type those in the question box. We will allocate some time at the very end of the presentation to get those answered for you. So again, my name is Reneika Lightbourne. I'm one of the business development specialists here at Advanta since 2019. I'm also an Advanta client prior to joining staff. So self-direction is something that I personally and actively do. If you have questions, you want to do a deeper dive, talk through your scenario, feel free to give me a call, send me an email, or you can visit advantaira.com to schedule a consultation. So just a little housekeeping before we get started. I'll just note that at Advanta, we don't give any tax, legal, or investment advice. All of the information that we're going to present today is just more so for educational purposes. So as always, we encourage you to do your due diligence and consult with your professional team, whether it's your attorney, your CPA, or financial advisor before you make any investments. So just quick takeaways, just know that any IRA or former employer plan qualifies to be self-directed. When you self-direct, you're always in control, meaning you get to decide what is it that you want to invest in. Today, we're going to be focusing on multifamily investing. And then, of course, any income that's generated from that investment flows back into your retirement account. If there's any expenses associated with that investment, it is paid out of that IRA account. So just a little history about Advanta and who we are. We've been in business for 20 plus years now as one of the leading self-directed IRA administrators in the business. While we don't give any legal advice, we do have a team of attorneys on staff and as well CISP certified individuals. Advanta, our headquarters is located in Largo, Florida, which is Tampa Bay. Advanta, we also have an office here in Atlanta, which is where I'm based, but we do work with clients nationwide as we have almost about 10,000 clients now, a little over $2 billion under administration. If you have cash sitting in your account with us, I do know that it is FDIC insured. I know recently a lot of people have concerns about FDIC insurance. With us, whether you have above $250,000, because it's spread across a pooled trust account, all of your funds are secured with us as long as it's sitting in cash. And then, of course, at Advanta, we separate ourselves by providing our clients high-quality concierge style service, meaning you have a dedicated account manager, a direct point of contact that's going to be with you for the life of your account with us. And then, of course, we have educational content that features guest speakers such as Joseph to come in and knowledge share with our audience. In addition to hosting weekly webinars, this is going to be uploaded onto our YouTube channel within the next 48 hours. We also have other events, which include our Pitch, Promote, Prosper online networking platform. So I would encourage you to check out our website to sign up for that. My colleague Alex also hosts a podcast, so I would strongly encourage you to, if you have an interest, feel free to check that out. And then our blog features all of the latest trends and news relating to self-direction. So exactly, what is a self-directed IRA? Just very simply, self-direction just means that you, as the account owner, you're going to have complete control over your retirement funds. You have complete control over the investment decisions, but also too, it really allows you to truly diversify outside of the traditional stocks and bonds. You can use IRA funds to invest in alternatives, which includes multifamily or apartment complexes. It can be single family homes, it can be tax liens, notes and mortgages, it could be private equity, precious metals, oil and gas, the list goes on and on in terms of what's on the table for you. So typically I get a question of, why do people choose to self-direct? It's many different reasons, but I'll just touch on 3 of them. 1, it can be a new source of capital for you. So if you have funds that's sitting in an old 401k or an existing IRA and you want to diversify, you can go ahead and move as much or as little as you want to and need to make that next investment. 2, the ups and downs, the volatility in the stock market. Obviously right now it's very sensitive with With the stock market, you can elect to move a portion of those funds to go out and buy real estate because we know, again, people are always going to need some place to live, and that includes obviously multifamily apartment complexes. And then, of course, the tax benefits. Having those rents, those profits, those dividends flow back into your retirement account, tax-free or tax-deferred, depending on the type of account that you have. The different types of accounts that can be self-directed, it's the ones that you're already familiar with. For individuals, you can self-direct a traditional IRA, meaning it's tax-deferred. You get the tax break up front. You pay taxes once you take the funds out at retirement. Whereas with a Roth IRA, you elect to pay the taxes up front, grow your account over time. As long as you've held that account for 5 years and your retirement age of 59 and a half, when you take those funds out, it's tax-free. If you are you have a small business, you're an entrepreneur, you have a side business, you can look to self-direct SEPs, simple solo 401ks. A lot of active real estate investors or real estate professionals really like the solo 401k because you have greater flexibility, higher contribution limits. If you do want to know more about that, we can certainly jump on a call and do more a deeper dive on that. Some lesser known accounts that can also be self-directed are ESAs to cover education-related expenses for your kids, grandkids, and then of course HSAs as well. As long as you have a high deductible insurance plan, you can look to self-direct your retirement account, your HSA account. And then of course any former employer plan, whether it's an old 401k, 403b, or TSP type plan or pension plan, you can elect to roll those over to self-direct. For 2023, the contribution limits did bump up. I do want to reference next month is the tax deadline, so you can still contribute for 2022 if you haven't already. But for 2023, for traditional and Roth IRAs, you can a combination of you can put in a total of $6,500 if you're under the age of 50, $7,500 if you're over the age of 50. And then starting in 2025, with the Secure Act that passed earlier this year, between the ages of 60 and 65, you have an additional $10,000 catch-up. But again, that portion doesn't start until 2025. If you have a SEP IRA, you can contribute up to 25% of your earned income, not to exceed $66,000. Solo 401k, same thing. You can contribute twice, once as worker, once it matches the owner. When you combine the two, you can contribute up to $66,000. For ESAs, it's $2,000 per year per child. For HSAs, for individuals, you can put in $3,850, and then of course, as a family plan, you can put in $7,750. If you're 55 or older with an HSA, you can put in an additional $1,000. The process with us to get started is pretty straightforward. When you're ready to proceed, step one, first and foremost, fill out the application to get your account open with us. You can do that directly on our website, or myself or one of my colleagues can send you a DocuSign link to where it prompts you to do everything that's needed. We do assign you a dedicated account manager. And then, of course, step two is funding your account. You can fund your account using a combination of making an annual cash contribution as long as you've earned income, transfer from an existing IRA, or doing a direct rollover from an old 401k or other employer plan. And then finally, step three, what is it that you want to invest in? At Advanta, we don't have a list of investments for clients to choose from. You have to decide or find what it is that you want to invest in. In this case, if it's multifamily, your account manager with us will help you dot those I's, cross those T's, and make that investment, make sure everything's properly make sure it's properly titled and vested in the name of your IRA. And then, of course, with that, I'll go ahead and turn it over to our featured speaker. Joseph, just bear with me. Let me make you the presenter.
So Apex Real Estate Investments is a privately held equity investment company, and we work with different syndication groups and invest in their deals as equity partners. So some of the benefits of investing in multifamily that I'll be going over today is group purchasing, the ability to leverage, operational efficiency, forced depreciation, return of capital, passive income, tax advantages, above market returns, and the hedge against inflation. And I'll go more in detail with these as we go. So group purchasing, investing in multifamily is very capital intensive. So by investing into, let's say, a syndication, it allows a number of people to combine their capital and then to have access to purchase a larger and potentially more profitable real estate investment. So For example, not everyone is going to have millions of dollars to just go out and acquire a 150 to 200 unit apartment building. But by taking their money and pulling together, now everyone can have ownership of that building that invested. So the way that works is the lead investor or the sponsor, they identify the property, they conduct the due diligence and the underwriting, then they secure property management, they organize their investment capital, and then they're required to guarantee the loan for financing the property. Also, the sponsor on the projects, they're the general partners. And so they're responsible for overseeing the operations of the property and providing reports to the limited partners, which is you all. The passive investors, which are the limited partners that purchase a fractional ownership in the property, they have no debt liability and no management or operational responsibilities. Basically, you get all the benefits, but you have none of the risk. So the second benefit is the ability to leverage. So investing in multifamily allows investors to use debt more strategically than with single family real estate investing. Some examples of this is, in most cases, when buying an existing multifamily property, the financing is non-recourse and does not show up as a liability on a financial statement. Also, the general partner or any LP investor with more than 20% ownership acts as the guarantor on any bank financing for the property. Now, the third part is the passive investors. The third part is the passive investors or limited partners. They get the benefit from the leverage and the bank financing without having to guarantee any loans. And then also the ROI to the investors are significantly greater as a result of the leverage used to acquire the building. A third benefit is operational efficiency. So investing in multifamily provides economies of scale and operational efficiency at affordable costs compared to single family investing. So the property is professionally managed with on-site property managers, a leasing staff, and maintenance. So just like, if you walk into your regular apartment building, how you have those office managers, leasing staff, and the maintenance crew running around fixing things, those are the kind of buildings that we're acquiring. The GP, they act as the asset manager and oversees the property level management. And then this also provides the best economies of scale because the values are on properties with 100 plus units. So by purchasing larger apartment buildings, it creates a better ROI for the investor. Another benefit, which is the fourth one, is forced appreciation. Now, the value of a multifamily property can be increased by reducing the operating expenses and increasing the income. So here's an example. By reducing the water bill by $25,000 per year at a 5% cap rate, the property value increases $500,000. Now, by increasing the covered parking, so you charge an extra $10 per month on 50 covered parking slots, so about $500 a month or $6,000 a year at a 5% cap rate, the property value increases $120,000. And then by increasing the rent, let's say $25 per month per unit on a 100-unit property, that's an additional $30,000 a year at a 5% cap rate. Now that property value increases $600,000. And then by upgrading the units, so charging an additional $150 per month by upgrading 50 units and adding the washer and dryers, that's $90,000 a year at a 5% cap rate. Now that property value increases $1.8 million. So in total, the property value increased in value by $3,020,000. The next part is return of capital. So a unique benefit of investing in multifamily long term is the ability to return 100% of investment capital and still own the investment. So one, after reducing expenses and increasing the income, typically within 2 to 3 years, the property will be refinanced or obtain a supplemental loan to return 25% to 75% of investor capital. This process generally continues every 2 to 3 years. The goal is within 4 to 6 years, investors have received back 100% of their original investment capital if the property has not been sold by then. If the property is held long-term, additional capital events through loan proceeds, distributions can continue to occur every 2 to 3 years. So if the property is sold instead of a long-term investor is sold instead of holding on, then you receive a return of capital first before a profits distribution. Passive income is another benefit. So multifamily investing can produce ongoing passive income even after investors have received back 100% of their original investment capital. So one, the income from multifamily is passive rental income. Two, the passive income distributions generally begin within 90 to 180 days after acquisition. So let's say hypothetically we purchased the property in January, you will see the first distribution anywhere between March or June of that year. Now, the year one cash flow is lower than subsequent years when the property is first taken over. The reason for this is because we're going in and we're doing the renovations and adding value to the property. So a lot of the money is going towards the renovations before the return can start increasing. Now, by reducing the expenses and increasing the rents and adding additional income, cash flow, that can increase each year. There are also tax advantages. Now, I will tell you, you don't get these tax advantages if you're investing through a self-directed IRA. But if you're investing through cash, then these are available to you. So this just says here there are significant tax advantages available by investing in multifamily. So some of the ways that this happens is we reduce income tax liability. So investors can substantially reduce their income tax via cost segregation, which speeds up the rate at which investors can claim tax deductions. Then there's tax savings. So income is taxed as passive rental income. Also through depreciation deduction. So you get annual depreciation. And then long-term capital gains tax. So because the property is held over 365 days, you pay long-term capital gains tax instead of short-term. Also, the loan proceed distributions are not taxable at the time received, even after investors have received back 100% of their investment capital. So let's say you invest 100,000 and we do a cash out refinance and you get the 100,000 back and we give you that back. That's not taxable. Also, you'll receive a Schedule K-1 every year. The next benefit is above market returns. So investing in multifamily can provide above market returns to investors through cash flow, capital events, capital gains, and tax advantages. So through cash flow in general, multifamily can produce cash flow between 4 to 10% per year of passive income. And then when the property is refinanced or a supplemental loan is used, part or all of the capital is returned, but you still have ownership of the property. So then by simply reducing the expenses and increasing income, even slightly, values can increase significantly to realize a strong capital gain on sale. And then between cash flow and gain on sale, investors on average can consistently achieve double-digit returns. And then also as a result, multifamily is one of the most predictable ways for investors to earn above market returns. Multifamily also provides a hedge against inflation. So it's considered a hedge against inflation since values increase as expenses on the property are reduced and rental rates are increased. So for example, in single family, investing has natural appreciation and depreciation based on the buying and selling activity in a particular submarket. So I used to be in single family for a while, and I remember always dealing with comps. That's basically what this is talking about. Is let's say the person across the street, they sold their house for 250, but you want to sell yours for 300 because you add all this value in it. Well, now you got to sell it for less because somebody else may have gotten their house foreclosed on the block or something. And that's just, yeah. So in multifamily, you have forced appreciation regardless of the submarket. So the value on a multifamily property is dictated by the net operating income. And then by simply reducing the expenses and increasing income even slightly, values can increase significantly. Also, it's predictable and stable. As a result, multifamily is one of the most predictable and stable investments available to investors to hedge against inflation. Also, on the last part, investing in multifamily can also be done inside a retirement plan through a self-directed IRA or other qualified plan, just like Reneika had talked about. So you can use your traditional IRA, your Roth, your traditional 401k. All these can be rolled over into a self-directed IRA. And then this is the last slide. So for more information, you can go to investingapartmentsnow.com.
Thank you so much, Joseph. I do want to kind of circle back. I know you referenced in terms of the benefit or the tax benefits of investing with your retirement account. It's already tax sheltered. So obviously any income that's generated flows back into your retirement account, tax-free or tax deferred. Typically when our clients use their account to invest in multifamily or syndication project, it may or may not be subject to UBIT. So UDFI tax applies in terms of IRAs. It doesn't apply to solo 401ks. Obviously, it depends on how that investment provider or that syndicator is reporting or sending back. Clients do get K1s as well for their self-directed account. But of course, any investment that you make inside of the retirement account, the returns, those are tax sheltered. Let me go ahead and open it up for question. If you can, just bear with me one moment. Let me pull up the question box. So Joseph, the first question is, what is your view or the landscape of the general real estate market currently?
So the conversations I've been having with my mentors and partners on this is that a lot of the investors who got into syndication, I would say like in the past couple of years, they're in a position where they might have to sell these properties anywhere between mid to late part of this year. And so if you're an experienced syndicator, then there's an opportunity for you to pick these properties up at a discount. And then also if you're new and you're just getting started and you're going out there to acquire these buildings, then it's also a great time for you as well to take advantage of the opportunities.
Okay, next question is, how long do you typically hold your apartments? Is it 5 years, 7 years, 10 years?
So on average, we typically hold them anywhere between 3 to 6 years.
3 to 6 years, okay.
Yes.
One question that came in, what is the minimum investment?
The minimum investment is $100,000.
Okay, so are you dealing specifically with accredited or non-accredited investors?
No, so we deal with accredited and non-accredited investors.
Okay. Another question that came in is, do you invest nationwide, and how do you understand, and how well do you understand each specific city that you invest in?
So we invest in landlord-friendly states such as Texas, Florida, Georgia, Alabama, all of the Southeast markets. And we recently acquired a property in Charleston, South Carolina, which is 160 units. That's an example.
Okay. So a question came in, says, when we fund the IRA, do the funds stay in-house or have the different institutions such as bank that host the funds? So if you open up an account with Advanta, like let's just say you have an IRA at, Fidelity or Charles Schwab, you open up an account with us, you would then have a portion, whatever amount that you decide you want to invest, move over to your Advanta account. Once it comes over to us, you'll work with your account manager who would work with that syndicator to fill out any subscription agreement. And then of course, once you give your consent, Advanta will then send that money over to that syndicator on behalf of your IRA. And then moving forward, whatever the terms that's agreed upon between you as the investor and the syndicator, let's just say they're sending money back monthly or quarterly or at the end of the 3-year, 5-year, 6-year term, they would then send it back to Advanta to be deposited into your account. So I hope that answers your question. Just bear with me. So question is, how do you and your team plan to hedge the current higher interest rates environment to ensure investors make a profit return, a positive return?
So something we do to hedge against that, just let's say hypothetically a property did underperform. Something that we do to hedge against that and protect our investors is that we offer a 10% downside performance protection hurdle on every property that we acquire, so that if a property was to underperform due to market conditions or something, then our investors will get the minimum of 10% annual return on investment before we take a profit.
Okay. Next question is, do you invest in your own deals alongside of passive investors?
Yes, we do. In fact, to acquire the Charleston, South Carolina property, we raised about $6 million in a month, and then took another $6 million of our own cash to put into the property to acquire that property.
Okay. Next question is, how many properties, doors do you have under management?
So at this current moment, 160 units. That's about 30 million in assets under management, and then also working on a property in Wichita Falls, and then also more property as well we're looking at right now.
Okay, next question is, are there any other initial costs before the minimum investment?
No, there's no other initial cost before the minimum investment.
Okay, just bear with me. Next question is, how is the deal structured in terms of profit sharing with LP and GP?
So it depends on the property. It could be anywhere between a 70-30 or 80-20. Yeah, in some cases 75-25. So anywhere between there. It all depends on the property.
Okay. I think you answered the minimum investment requirement. Just bear with me, I'm going through. Question is, how frequently are distributions made?
We do them quarterly, and we're in talks of possibly doing them monthly, but as of now, they're quarterly.
Okay. And to piggyback on that question is, how often you communicate or provide updates? Is it also quarterly?
No, we do that monthly. In fact, you'll get an entire overview of everything that's going on with the property to the most minute detail, so you can know.
Okay. Question is, can I get a copy of this presentation? Yeah. So this webinar will be uploaded onto our YouTube channel within 24 to 48 hours. You'll also get an automated email from Advanta as well. And if you'd like a copy of the presentation, feel free to let us know, and we'll certainly send you a copy of it. Next question is, does your company manage the property directly, or do you have a third-party property manager that you work with?
We use third-party property managers.
Okay.
And we just oversee the third-party property managers as the general partners on each property.
Okay. Next question is, do you invest in storage units, nursing homes, condos?
No, we do not at this moment, but that is something that could possibly come in the future. Also, emergency rooms, freestanding emergency rooms. It's another thing that can come in the future.
Okay. Question is, what type of insurance do you carry, or can you talk about the type of insurance, or what is it in place to protect investors?
So as far as the type of insurance, that's something that I would have to get to you here. I mean, I guess you have to reach out to me through my website. Go there, set up a time to reach out to me, and I can get that over to you. But I can't just talk about that over the webinar.
Understood. Let me just go through, see other questions. So what is your historical performance or track record? Have you dealt with a downturn in the market?
What is that question again?
It says, what is your historical performance or track record? Have you dealt with a down market?
Oh, so yes, my partners, they've been in business for 20 plus years. The lead syndicators on each deal for the pre-existing properties, and they average a annual return on investment for exited projects of 29%. So they've definitely went through a down market.
Okay, question is how long?
Yeah.
Go ahead, I'm sorry.
Oh, no, I was just saying they've definitely been through a down market if they've been in this for 20 plus years, averaging those kind of returns.
Okay, and I guess the follow-up question to that is how long have you been in business?
So this particular fund for over a year now, as far as the syndicators that will oversee these properties as well that I invest with, 20 plus years.
Okay. Next question is, what is the typical debt to equity ratio of your properties?
Again, that depends on the property. So if I remember correctly, the one in Charleston, South Carolina was 65-30. I will have to double check. It's definitely on my website, but I have to double check. I have a case study so you can look at it through the website as well.
Okay, I'm just going through questions, just bear with me. I think you answered how the deal is structured, the minimum investment. I think you may have answered this, but I'll ask to clarify. What miscellaneous fees do you charge for?
I do not charge my investors any miscellaneous fees because I invest in each apartment building as an equity partner and come on as a general partner alongside the lead sponsors. So I get paid from whatever fees that they already have.
Okay. So question is, are these investments subject to UDFI, unrelated debt finance income tax because of debt financing? So if you're using retirement accounts, IRAs, it's possible that your IRA could be subject to UDFI tax, but again, that's more so depending on the syndicator and how they're financing, you know, if they're using debt to finance those investments, those properties. Final question is, can you provide your contact information once more?
Yes, so to reach out to me, here's my website at www.investingapartmentsnow.com. And then also to reach out, you can message me, call me at 469-540-5031. Call or text that number.
Okay. And I think, let me just double check, see if there are any more questions. I think that covered all of the questions. Joseph, thank you so much for taking the time to come in and knowledge share with the audience. Thank you all for your questions. Again, this webinar will be uploaded to our YouTube channel shortly. If you want to know more about self-direction or you need clarification on anything, feel free to reach out to me directly. Let me just change to show my screen where you can have my contact information. Again, you can call me, you can email me, or you can visit advantaira.com. It's a great resource, a great wealth of knowledge. Any parting words before we disconnect, Joseph?
I would just say thank you for having me on, and definitely looking forward to coming on again if y'all would have me.
Thank you so very much. Yes, absolutely, and we'll talk about some of our other networking opportunities that we have available. Wait, I do have one last question that came in.
Okay.
So the question is, how many customers of Advanta has invested with Apex? So just to clarify again, at Advanta, we don't tell our clients what to invest in or where to invest. So it's more so you as the client have to decide, hey, I want to invest with Apex or I want to invest, you know, XYZ. We're just acting as that neutral party, that custodian to help you dot those I's and cross those T's to make sure it's done correctly within accordance to the IRS rules. And if there are no more questions, we'll go ahead and disconnect. But again, if you want to know more, feel free to reach out to me. Thank you, Joseph.
All right, thank you.
Thank you, everyone. Have a great rest of your day.